common investor question these days is whether or not the Fed is going to hike at its next policy meeting. Well, that's a good question. To me, a much better question is, how effective is monetary policy going to be in the future? Historically, when the Fed wants to affect the economic outlook, they either raise or lower short-term interest rates. And that has knock-on effects to the rest of the economy, whether or not that's long-term interest rates, inflation, or investment. However, the US economy has changed meaningfully over the past few years, across three different dimensions. First, AI capital spending seems pretty independent in terms of the level of interest rates. Second, the inflation we're seeing in the economy has been mainly driven by the supply side. This is not the demand side inflation that the Fed's tools is more adept at dealing with. And finally, long-term interest rates are moving pretty independent of short-term interest rates because long-term interest rates are much more concerned with things like nominal growth and the supply coming out of the Treasury. So what does this mean for investors? Really three different things. First, expect short-term interest rates to be a lot more volatile than they have historically because the Fed is going to have to adjust policy more aggressively to have the same economic outcomes. Second, long-term interest rates are going to continue to be uncorrelated with short-term interest rates. And finally, investors should probably spend less time thinking about the Fed's next move and more time thinking about things that can affect long-term interest rates, like the growth outlook, AI capex spending, and the deficits we're experiencing out of the federal government. So while it is a good question to say, what is the Fed going to do next? To me, a better question is, how effective is monetary policy going to be in the future?